Very good evening to all of you. Welcome to another YouTube live session with me, Srijit Kakkar. Today we will be getting on to our lesson number 14, and today we will be understanding what we talked in the last two sessions. We understood what is implied volatility, we understood what is historical volatility. Now, how do we use both of them combined together? That is what we will be covering today. Very, very important topic because this is what is going to help us understand when we should be buying options and when we should be selling options. So again, if you have still not gone through the previous lessons, make sure you people do that. I have the link to the playlist available in the description, both English as well as in Hindi. So make sure you people go through all the lessons. And yes, if you're liking these sessions, make sure you hit the thumbs up button, like the video, share it with your friends, share it with your family members. The options course is absolutely free, and that is what we are covering for the last few weeks. Today, we will be on lesson number 14. All right, so before we move ahead, let's get done with the formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. Now, today, like I said, we are on lesson number 14, and lesson number 14 is where we will be now putting together historical volatility and implied volatility to understand how to gauge when to be a buyer of an option and when to be a seller of an option. Now, yes, we started with options volatility about two sessions ago. We are still continuing with options volatility. Now, just to recap, what is volatility? We talked about volatility is basically the measurement of speed. Now, what do we mean by measurement of speed? Now, if we go from point A to point B, right? In let's say if I'm driving a car, I go from A to B, and how much time do I travel from A to B basically tells me at what speed am I traveling. So similarly, what is volatility? If price moves from one price to another price, let's say from 100 to, just a second, so from 100 to 110. So how fast did it move from 100 to 110? That is basically the speed of the price, which is basically the volatility. If it does this in 10 days, 15 days, 20 days, maybe the markets are not very volatile. But if it does this in, let's say, a few minutes, very volatile market. So can you see the speed is basically what we mean by the volatility, that how fast prices are moving from one price to another price. Now, when we talked about volatility, we discussed that there are two kind of volatilities. One is the historical volatility, the other one is implied volatility. So again, let's quickly recap that before we move ahead. So historical volatility is based on the underlying. Historical volatility measures the speed which has been in the recent past, right? It is not telling you what can happen in the future, but this is telling you what has happened in the past. And that is why it is lagging, because it is telling me what happened in the past. Now, when it comes to implied volatility, this is not based on the underlying, this is based on the options price. This is the measurement of speed for the futures, right? So, this is basically telling you what is the crowd expectation is, what the crowd is expecting might happen in the future. That is what the implied volatility tells us. And this is instantaneous because it reacts to crowd psychology, and because it reacts to crowd psychology, it can move to unreasonable extremes, right? So it can be very unreasonable extremes. So now when we talk about volatility, you can see volatility is more like a pendulum, right? So at times people will be very calm because nothing much is happening in the market. They are very calm, and all of a sudden, if they know that some news is about to come up, or maybe the stock starts moving, what happens is from calm they start moving on to the panic mode. And what happens is, let's say if there was some news, once you know that news, so now the unknown is known, that panicness would again uh, fade out and will again be moving back towards the mean price. So this is what happens, that your volatility is because of the emotions, and emotions, always keeps on fluctuating. So if people are very calm, eventually they will come to the mean, and similarly if people are panicking, they'll again come to the mean. Now, if you look at an example, implied volatility value can vary greatly. Taking advantage of these fluctuations is the key to being a profitable options trader. For example, a 9200 call with 25 days until expiry might be as low as 55 when implied volatility is low. And the same option, right? The same call option, the same strike, the same expiry, 25 days to expiry, might even be trading at 145 when the implied volatility is very high, which means when people are panicking. So can you see it's going to be the same call? the same number of days to expiry, the same strike price, but depending upon how the crowd psychology is, it can be priced very cheap, or it can be priced very expensive. So now the question comes that how do we understand whether it is cheap or whether it is expensive? And that is what we will be focusing on today, because again, like I said, volatility is more like a pendulum. So the more it goes to the calm side, now the higher is the probability it will again revert back to mean. And similarly, if people are panicking, higher is the probability it will remain, it will come back to the mean, because whatever reason was for that panic, once that has already happened, that event has happened, again, things go back to the mean price. So let's move ahead. So this is what we need to understand when the options pricing are deflated, which means cheap, and when they are inflated means expensive. So let's understand what is inflated versus deflated. Now the options are priced based on the probability and expectation of price movement, right? Now if you go back to our lesson number 1, right, which is where we talked about the apartment which was for 2 crores, and we said the person who is selling is happy doing the contract for 5 lakh rupees. But then we added a condition there. What if that person had some information that maybe close to that apartment, some mall is coming up, or maybe some theme park is coming up, or maybe in the same building some Bollywood celebrity is coming up? Then maybe he might not be interested in accepting 5 lakhs. He might be interested in accepting 2 lakhs for that same transaction. So can you see, from 5 lakh it went to 20 lakh because of the probability and the expectation. So the price of the underlying did not change as of now, right? It was still at 2 crore, but because now that person was having that probability and expectation, this price fluctuated, right? So that is why we were talking about that your implied volatility is instantaneous, because as soon as somebody has some information, or you have some news, because of crowd psychology, it can go to extremes. So now if you try to understand that, what do we mean by inflated versus deflated? Just a second. The higher the implied volatility, the higher the options premium. Because when we talk about options premium, we talked about options premium is made up of two things, right? One is your intrinsic value, right? Intrinsic value plus the time value. Now, if we forget that intrinsic value for a minute, the time value has certain parts which we discussed about in the last session when we were talking about implied volatility. Now, all other things could have been calculated. The only thing we were not able to calculate was the IV. So the more the IV, right, the more the implied volatility, the more expensive that option would be, right? So the higher would be the premium. So the higher the implied volatility, the higher the option premium for the same participation, right? So the same strike price, the same expiry. So for the same participation, higher would be the premium. So the higher the implied volatility means more inflated the option is. And this basically translates to that the options are expensive. And as an options trader, we would love to sell expensive options. Similarly, the lower the implied volatility, the lower the options premium, right? So the lower the implied volatility would be, the premiums would be lower for the same participation, and the lower the implied volatility, less inflated that option is, which means the options are currently at cheap price, and we would love to be buyers of cheap options. So this is why implied volatility is the key criteria for us to understand when to buy options and when to sell options, because the more lower the implied volatility, the cheaper those options are, and the higher the implied volatility, the more expensive the options are, right? So we will be deciding whether the options are cheap or expensive by understanding the implied volatility, right? So now we talked about historical volatility. When I showed you this here, you can see the value is 75, right? We also understood what that 75 means. So this is basically telling me, now if we take this example of Nifty, that based on what has happened in the past, Nifty can move around 429 rupees in a day, right? Similarly, we also talked about the implied volatility, and here you can see my implied volatility value was 36.23. So implied volatility is telling me that even though based on the historical volatility, people are expecting it to move around 400 rupees. What was the exact number? Let me just check. 429. So let's make it 400 as an example. So based on what has happened in the past, which is your HV, right? This is the HV value, historical volatility. It can move around 400 rupees, right? It has been, I won't say it can move, it has been moving 400 rupees, right? That is what the historical volatility is telling me. And what is the implied volatility telling me? Implied volatility telling me is that as if now people believe that in the future, in one day, it can move around 200 rupees, right? This is my implied volatility. So this has been happening in the past, and this is what people are expecting in the future, right? So currently, is the implied volatility high or is the implied volatility low? That is what we will be understanding. Now, generally, what people they do is they compare these two, because you can see this is 200 and this is 400. They'll say the implied volatility is less, but this is not the correct way to do it. We will be understanding what is the correct way, but this is what a lot of options traders they do. They just compare the HV and the IV. If the IV is less than HV, means the implied volatility is low, and if the IV is greater than HV, then it is the options are expensive. But we'll not be doing it this way. We'll be doing it in a very different way, and we'll also be understanding the logic behind it, right? But yes, now to understand from these two numbers, this is telling me this has been the speed in the past, right? Now let's take an example of a car. So in the past, this car has been uh, running with the speed of 400, let's say, kilometers per hour. But what people are expecting as if now is that it might be now moving with the speed of 200 kilometers per hour, right? Just to make it very simple as an example. All right, so let's move ahead. Now, implied volatility determines the strategy. Is implied volatility high or low? The answer will determine which option strategy to use. So, that is what I was telling you, that we will be deciding when to buy options or when to sell options based on the implied volatility. Now, what can be the condition? Condition can be that the script is at supply, which means we are planning bearish trades. Now, yes, I plan my trades using demand and supply methodology. If you're using some other strategy, which might be, let's say, a resistance area, because you're at resistance, you want to plan some bearish trades, maybe using some Fibonacci levels or whatever your strategy might be, right? So, as a demand and supply trader, because we are at supply, we want to plan bearish trades. Now, what can happen is two conditions can happen. As if now we are talking about two conditions. As we move forward, we'll be talking about more conditions as well. Those two conditions are implied volatility can be low or implied volatility can be high, right? Low basically means cheap and high means expensive, right? So low means cheap, high means expensive. So what can I do? Because I am at supply, right? Because I am at supply and the implied volatility is low, I would not like to sell options. I would like to buy options, right? So the first thing I know for sure is I will be buying options, which means plus. And because I want to create a bearish position, right? So I should be buying a negative unit. So what is a negative unit? When we talked about calls and puts, we know puts are negative units, which means I should be buying a put, because put is a negative unit. So plus minus becomes as minus, which will be a bearish position. So yes, if the implied volatility is low, we want to be a net buyer, right? Which is basically positive, and a buyer of puts. Why? Because put is a negative unit, which basically implies now I have a bearish position. And the reason I created a bearish position is because I was in supply and implied volatility was low, which means as if now the options are cheap. And this will be a debit strategy, because whenever you're buying options, you will have to pay something. This is going to be a debit strategy. Now, if the implied volatility is high, which means the options price as if now is expensive, now I would not like to buy expensive. Now I would love to sell expensive. And because now I want to create a bearish position. So how can I do that? So first thing I know for sure is I will be selling. Now, if I'm selling a put, what will happen is minus and minus will become as plus, which is basically a bullish position, not a bearish position. So what I should be selling now? I should be selling a positive unit. So I will be selling a positive unit, which means you will be selling a call now. And by selling a call, you will be having a bearish position. So this is what we will be doing. We want to be a net seller. Why net seller? Because we know implied volatility is high, which means expensive price. And because we want to sell, we cannot sell a put, because minus minus will become as a bullish position. Minus minus becomes plus. So what do I need to sell now? I should be selling a call, because call is a positive unit. So I sold a positive unit. And by selling a positive unit, I will be collecting some credit, and that is why it is called as a credit strategy, because you'll be collecting that premium, and that premium is basically the credit you're getting. Now, similarly, if the script is at a demand area, now at demand, we want to plan bullish trades because we are expecting prices to move up, and that is why we want to plan bullish trades. So, if the implied volatility is low, so again, if the implied volatility is low, means cheap price. So, cheap price we would be interested in buying, right? And we want to have a bullish position. So, plus will be plus. So, what is plus? Your calls are positive units. So I will be buying a call because by buying a call, I will be creating a bullish position. So we want to be net buyer. And the reason for that is the implied volatility is low, which means cheap price. So I want to buy and I will be buying a call because by buying a call, I create a bullish position. And this is going to again be a debit strategy because whenever you're buying, you will be paying some premium, which will be debited from your account. Now, if the implied volatility is high, which basically implies we are at expensive price now, and at expensive price we would not like to buy, we would like to sell, right? So the first thing is I'll be selling, and now I want to create a bullish position. So if I sell a call, then what is happening is plus minus is minus, and minus is not a bullish position. But if I sell a put, because put is a negative unit, then minus minus becomes as plus, right? So minus minus becomes plus, which means now I have a bullish position. So what we will be doing now is we will be selling a put because selling is negative. Just a second, right? So selling is negative and put is a negative unit, so minus minus becomes as plus. So now I have a bullish position in which I will be collecting some premium. Now why am I collecting premium? Because I know currently the implied volatility is high. The correct thing to do would be selling options, not buying options. And this is again a credit strategy because I will be collecting that premium which will get credited to my account. So this is what we need to understand. What is the implied volatility? Is it high or is it low? Because based on that, we will be deciding whether we want to buy options or we want to sell options. So now how can we do that? There are a few different ways. So like I said, this is the trader's challenge. I should have said this is the options trader challenge. How to understand when to buy and when to sell, or in a way, how to understand when the implied volatility is high or when the implied volatility is low. So determining what is inflated and what is deflated, that is the biggest challenge. Because if the options are deflated, we would love to buy options. And if the options are inflated, we would love to sell options. So that is why it becomes very, very important for us to understand whether currently the options are inflated or whether currently the options are deflated. Now, traders they use different methods to understand options premiums are inflated or deflated. Now, some of the ways which people they use is one is they compare it with the volatility index versus the implied volatility, and the second one is historical volatility versus implied volatility. I just talked about it just few slides ago. We'll again be touching upon it, but let's understand first the very first method, which is volatility index versus implied volatility. So, if I go to just give me a second, let me bring up my charts. Okay, just a second. Perfect. So if I go to Nifty, not Nifty, in fact, if I go to my charts and I will look for India, India VIX, right? If I go to India VIX, go to the index, you will be able to find India VIX. So what is India VIX? India VIX is basically your volatility index for the Nifty 50, right? So your index, which is the Nifty 50, this is the volatility index for it. And like I was saying, can you see when because of Corona in March, April, the market started crashing. Can you see how fast the implied volatility increased? So can you see when, at this time, Feb, we were at around 14, and now all of a sudden by the end of March we were almost hitting 90, right? So can you see, this is what I was telling you, crowd psychology is something which can go to extremes, and but you can see whenever it goes cheap again comes back to mean, it goes high again it starts coming back to mean. So that is why we need to understand where is the mean, where is the high, where is the low. So yes, that's the VIX. So what people they do is, like, currently you can see the India VIX is telling me that the value is 19.2, right? So what they will do is they will look at the implied volatility. So I'll again bring back this. So let's say I want to let's imagine for a minute I want to plan trade in Nifty itself. So I can see currently my IV of Nifty is 17.13, and this is telling me that the India VIX is telling me that Currently we have the value of 19.2. So because this is less than this, we can say maybe the options are priced cheap currently, right? So if the options are priced cheap, we will be looking for buying opportunities. Now, this is what many of the people they do just to make things simplified for them. Now, example, what I can also do is I can say, okay, I now want to see for Reliance. So I'll just wait for some time this to load. Now you can see Reliance is 36.24 and the India VIX is 19.2. So I can say because my implied volatility is greater than my India VIX, which is 19.2. So I'll say maybe currently the options are expensive. But yes, a lot of people they use this, but this is a crude way of looking at it. This is not the right way. Why now? This is not the right way because if you think about it for a minute, your Nifty is like the broad market, right? So let's say I can say Nifty is more like my, just to give you an analogy, let's say Nifty is my uh, automobile industry, right? So this is my automobile industry. And let's imagine that Reliance is like my let's say for a minute, a scooter, right? Now, I can't compare what broadly an automobile company, I mean, sector is doing versus a scooter, right? Because it is way extreme. Similarly, let's say for a minute, let's assume that Reliance, I say Reliance is more like a sports car. So now I can't compare a sports car with the complete auto sector because that doesn't make sense because we are doing a very crude judgment what the India VIX is telling and what that particular stock is, because a stock might be a very slow mover, a stock might be a very fast mover. So that is why comparing it with broad market might not give you a clear indication of whether the implied volatility is less or whether the implied volatility is high. So now what a lot of people they start doing is to overcome this challenge. Just give me a minute. Right. So to overcome this challenge, what a lot of people they do is instead of comparing it with the volatility index, like here you can again see the example is we are looking at Nifty. We have a value of 36.23, and if you look at here, this is 39. And since your implied volatility is less than VIX, people will say that the options are deflated, but like I said, it's a crude way of looking at it. Now the next way of looking at it is by comparing the historical volatility and the implied volatility. Like here you can see my historical volatility was uh, 75.14 and my current IV value is 36.23. So now we are not comparing with someone else, right? We are comparing Nifty with Nifty, but Nifty's HV with Nifty IV. Similarly, if I now go to Reliance, just give me a second, let me bring up Reliance just as an example. So if I now go to Reliance, can you see now currently I was comparing Reliance with India VIX, but now if I go to Reliance, let's go to Reliance stock. So now I'm not comparing, I'll say, apples with oranges, right? Now I'm comparing the same thing with the same thing, right? I'm comparing Reliance with Reliance, but now what am I comparing? Just give me a second. Let me bring this up so that I can get the values. All right. So can you see now I have the values here? So now what am I comparing is the historical volatility. So you can see my historical volatility is 27.18 and I'm comparing it with the implied volatility. So what is my implied volatility of Reliance as of now? We got a number which was 36. So if I'm looking at this number, now I know that 36 is greater than the historical volatility, which is 22.34. Therefore, we can say that currently the IV is expensive, and if the IV is inflated, we should be looking for selling opportunities, right? But now again, this is also just a not a very fine-tuned way, but still much better versus India VIX, but still not a very fine-tuned way. Why now it is not a very fine-tuned way? Because if you think about it, uh, okay, let me first go to the next slide and then we'll talk about it. So let me just bring up that slide. Oh, right, just a second. Right, so now volatility measurement and methodology, that is what we'll be understanding. So, like I said, the problem here is when we are comparing, we are only seeing what has been the recent historical volatility, right? That is what the historical volatility tells us, which is for the last 30 days, right? It tells us based on the last 30 observations, which is the last 30 days. Now, if you think about it, it actually does not tell us the nature of the script. Why? Now, let's take another example. Again, I'll take an example of a car. Uh, a car is capable of, let's say, moving at a speed. Let's say when you are driving it, or you're parking it, you might be driving it at 10 kilometers per hour, right? When you are driving your car in the city, you might be driving 50 kilometers per hour, right? And when you are driving it on the highway, you might be driving, let's say, 100 kilometers or 110 kilometers per hour. So can you see, the car is capable of going as slow as maybe 100. The car is also capable of going maybe as high as 110. But just because for the last 30 days I have been driving it at a speed of 50 kilometers does not tell me the actual nature of that call, or of that car. Right, you're getting my point. So now, if we have a sports car, we know a sports car might be capable of going to maybe 250 or 300. But just because we have been driving it in the city does not mean it has a nature of, let's say, 40 kilometer or 50 kilometer per hour. It's just that, as if now this is what it has been doing, but its capability can be to some extremes. So this is why whenever we are trying to measure the volatility, what we do is we try to understand the nature of the script, what it is capable of doing. And how do we find its nature? The way we find its nature is by dividing the range of the historical volatilities from the 52-week high to the 52-week low into 5 equal parts. So this is what the script has been capable of doing when it was moving the slowest or when it was moving the fastest. So I'm not trying to see what has been now happening in the last 30 days. I'm trying to see what has happened in the last 1 year. So in the last 1 year, what was the slowest speed of that car, or what was the fastest speed of that car? That is what we are trying to understand now, which gives us much better clarity. Now, another example can be, let's say, if you have a boyfriend, or if you have a girlfriend, or if you're married, you have a spouse. Maybe the very first day you don't know how their nature is, right? But eventually, when you spend more time with them, you get to understand that when they are, let's say, really angry, what is their extreme, but when they are very happy, what is their, the other side of it. So similarly, we are not trying to see what has been happening in the last 30 days. We are trying to see over a period of time what has been the slowest speed and what has been the fastest speed, right? That is what we do. So let's assume that when we are looking at a particular script, the 52-week high of the historical volatility was 150, and let's say the 52-week low of the historical volatility was 50. So I know when this script is calm, the minimum it has gone in the last 1 year is around 50, and when the script is very fast, the maximum it has gone is around 150. So what we do is we take these numbers 50 and 150 and we divide it into 5 equal parts, right? So we divide it into 5 equal parts. So now this lowest part is what we call as very deflated, because we know this has been the minimum which it has been able to do in the last 1 year. If it goes a little above, then we say yes, it is cheap, but not very cheap. It can further go cheap, because that is what I've seen in the last 1 year. Now, if it is between, I mean, the third range, the third zone, we can say that this is the fair price. This is basically the mean price. Now, if it is a little bit more than that, then we can say it is a little expensive. But yes, it still has room to become more expensive, because in the last 1 year, I have seen that it has the capability of being even faster. And yes, if it is in this range, then we'll say it is very inflated. So again, we do not decide just based on expensive or cheap. Now we divide it into 5 different zones or 5 different sections. Section 1 is your very deflated, section 2 is deflated, section 3 is fair price, section 4 is inflated, and section 5 is very inflated. So the sections define the current level of inflation for the premium and therefore the optimal option strategy to use. So as we move ahead, we will be learning which option strategies we should be applying based on where is the implied volatility as of now. Because let's imagine we are in a demand zone. So we might be in a demand zone, but there can be 5 different sections for the options IV, right? Options can be very deflated, deflated, fair, inflated, or very inflated. So based on in which section is the implied volatility, we will be deciding which option strategy we will be using, right? We compare what the crowd believes, right? So your implied volatility basically tells us what the crowd is believing. That is what IV is. So we compare what the crowd believes about the script versus what the script is realistically capable of, since we know implied volatility has the tendency to return to the mean. So people might be expecting something, but we know this is what it has been doing in the last 1 year, maybe the maximum. Maybe people are expecting it to get even more expensive, but now we understand it might return to mean. Or maybe people are expecting it to go, I mean, get become even slower, but we are expecting it to return to mean. So this is why we understand what it has been doing when it was the slowest, what it was able to achieve when it was the fastest, and then based on that we divide it into five equal parts. So if I go back to the chart, this is what we will be doing. You can now, in fact, what I'll do is I'll go back to the charts and let's bring up rel just a second, let's bring up Reliance again. So now you can see that this is telling me when Reliance was moving the fastest, we were at 104.20, and when Reliance was moving the cheapest, we were at 19.02. So here you can see in green and red, 19.02 was the lowest and 104.20 was the highest. And now what you can see is that I have divided this into five equal sections. So this is section 1, this is section 2, this is section 3, this is section 4, and this is section 5, right? So now what we will do is, now we understand these are the five sections we have. Very cheap, cheap, so this is very cheap, cheap, fair price, expensive price, and very expensive price. I mean, very inflated, I should have said. Very deflated, deflated, fair price, inflated, very inflated. Now, what I will be doing is the implied volatility value, which I got from my Excel sheet, which is 36.24. I'll input that value into this indicator. This is 36.24, 36.24. And now this indicator basically tells me that currently, if you look at the Reliance is at cheap price or very deflated, right? I can even say very deflated. So if I want to plan an options trade on Reliance, I would be more interested in planning long trades or buying options versus selling options, because options are as of now very deflated. So what is going to happen if the price starts moving in my favor, be that a long trade or a short trade? And along with that, because we know that if it is deflated, it can again start going back to the mean. So if it starts going back to the mean, then I will be getting paid by direction. Plus, I would also be getting paid because the implied volatility will start increasing. So, implied volatility will also pay me. The direction would also pay me. The only thing which will hurt me will be the time, right? Because every day, because of time, I will be losing some money. But two dimensions can make me money. One dimensions I might be losing money. So this is how we decide where we are. Now, can you see when we compared the same thing with India VIX, we said we are at expensive, but now we have a much clear understanding that it's not expensive. Currently, we are at very cheap, because realistically, this is what this script was capable of doing. This is what it has done in the last 1 year, and currently we are at very cheap price. So let's take another example. Let's say I look at maybe ICICI Bank. Right, so now this is telling me that realistically, in the last 1 year, when ICICI was moving the cheapest, we were at 16.75. Here you can see the numbers. And when it was moving the fastest, we were at 110.74. So now what I'll do is, again, this has been divided into five sections. So you can see section 1, section 2, section 3, section 4, and section 5. And now what I'll do is I'll get my value of implied volatility. So I'll bring up my Excel sheet. I'll say I want ICICI Bank. And let's wait for this sheet to get updated. And you can see my current value is 37.34, right? So what I'll do is I'll change this to 37.34. 37.34. Oops. 37.34. And now I understand that if I look at my implied volatility, we are not very deflated, because this is deflated, we are deflated. So what is going to happen is it it can move to deflated. I mean, very deflated, because it still has a little bit of room to move down, but it can also move up. So what strategy to be applied here, we will be learning as we move ahead, what strategies to be applied in which sections. So we will be covering them as we move ahead. But yes, this is what today's topic was: how to understand whether the options are expensive or whether the options are cheap. And yes, coming back to this indicator, currently this indicator is only available to our POS Plus subscribers. Uh, it is not a public indicator, because there are certain things which we have to do using that Excel sheet. But yes, once I find an alternative where maybe everything can be done on the chart itself, I might make it as a public indicator. But currently the POS plus members, they get it as complimentary, right? So those are the only people who have access to this indicator for now. But yes, this is what this indicator is all about. It tells you what are the different five sections, and by inputting the value of implied volatility, we can understand it much more better, whether the option pricing as of now is very deflated, deflated, fair price, expensive price, or very expensive price, because that will be the key criteria for us to understand which option strategy should I be using as of now. All right, so that basically brings us to the end of today's session. Okay, so this is just an example. So here you can see, we were having a value of 36.23, and 36.23 lies in the fair section. So that's your very deflated section 1, section 2 deflated, section 3 fair, section 4 inflated, and section 5 is very inflated. So this example shows you that at this given point of time, Nifty was in the fair value. But if you look at your uh, historical volatility and implied volatility, you might call it as cheap, but can you see it's not cheap, it is at fair. So that is why it gives you much better understanding of what the options are doing as of now, and to plan trades in a much mechanical and much more better way versus comparing it with India VIX or just the historical volatility. All right, so that brings us to the end of today's session. Thank you so much for joining in. I will be again seeing you probably on Friday when we'll cover the same topic in Hindi. And again, I'll add, in case you're liking these sessions, make sure hit the thumbs up button. And yes, if you have any questions, queries, you can definitely put it in the comment section. I try to answer these questions. I mean, whatever questions I get, I try to answer them as soon as possible. So I'll be seeing you again pretty soon during the week. Till then, enjoy your evening. Take care. Bye bye.